So are you ready to unlock the secrets of the stock market? Today we're diving into one of the most heated debates in the world of investing: dividend stocks versus growth stocks. Which one is better for your financial goals? And which one can make you more wealthier? So let's find out. You have probably heard skeptics saying things like dividends aren't free money, or growth stocks always outperform dividend paying ones. But is that really the full story? Let's dig deeper. First, let's make sure we are all on the same page. Imagine this. Dividend stocks are like getting a paycheck from a company you own a piece of, while growth stocks are like owning a small business that reinvests all its profits to grow faster. Dividend investing gives you regular income through dividends, while growth investing offers potential for big gains as the company grows. So what's your style? The steady paycheck or the big win? Well, some critics argue that dividends aren't free money and that growth stock always outperform. The reality is much more nuanced. Even Warren Buffett, a legendary investor, prefers to reinvesting profits into the business rather than paying dividends. So consider the story of Peter Lynch, another legendary investor. Peter once helped turn around a struggling store that was close to going out of business. Shareholders wanted dividends, but Peter suggested using the money to improve the store instead. They upgraded the products, they refurbished the store, and they opened new locations. And this reinvestment strategy led to greater success and higher long-term returns for investors. So Peter's strategy mirrors Buffett's belief in reinvesting profits back into the business rather than distributing dividends. But does this mean you should forget about dividend stocks altogether? Not so fast, because what if you could have the best of both worlds? Reinvesting dividends is like planting seeds to grow into a money tree. Over time, those seeds grow and multiply, creating a robust and steady stream of income. So did you ever heard someone say dividends are free money? Well, they are not entirely wrong, but there is more to the story. When a company pays dividends, for example, the stock price usually drops by the amount of the dividend. Think of it like slicing a pizza. When you take out a slice to eat, you have less pizza left, but the slice is yours to enjoy. The same counts for the money from dividend isn't free, but it's your share of the company's profit to do with as you please. So let's cut through the noise and get to the facts, because it's time to talk about numbers and see the real difference between these investment strategies. Are you curious to see which investment strategy, dividend or growth, comes out on top? Let's look into the total returns of some of the biggest names into the market over the past 5 years. You might be surprised by the results. Nvidia, 350% return. Apple, 200% return. Microsoft, 120% return. Google, 115% return. McDonald's, 81% return. Starbucks, 77% return. Meta, 70% return. Amazon, 60% return. So leading the pack is Nvidia, a powerhouse growth stock boosting an incredible 350% return. But don't count out dividend stocks just as Apple, a top dividend player, isn't far behind with a staggering 200% return. Interestingly, dividend players like McDonald's and Starbucks have outpaced Meta and Amazon in a total return during this period, proving that dividend-paying companies can achieve significant growth. So which strategy fits your goals the best? And what about your risk tolerance? Choosing between dividends and growth is like choosing between a steady job and a startup, because both have their perks. But one thing is for sure, in the world of investing, patience pays off. So the question is, do you have to choose between the two? So are you torn between the steady income of dividend stocks or the high reward potential of growth stocks? Then you have to see this. Because dividend stocks offer a reliable income stream, stability, and has the power of reinvesting dividends, especially when you are a retiree or those seeking for a steady income stream over time. This could be a game changer for you. So let's put this together. Income focus. Dividend stocks provide regular income through dividend payments, and this can be especially appealing for retirees or those seeking for a steady income stream. Stability and reliability. Dividend-paying companies are often well established and financially stable, offering lower volatility and a more predictable investment experience. The reinvestment opportunity. Investors have the flexibility to reinvest dividends to buy more shares, which can compound returns over time. On the flip side, growth giants like Google and Nvidia have skyrocketed by reinvesting profits, providing spectacular returns through innovation and expansion. So growth stocks have these things in common: a higher risk with a higher reward. These stocks typically experience more volatility and are suited for investors with a higher risk tolerance and a long-term investment horizon. Minimal immediate income. Growth stocks do not provide regular dividend income, so returns are primarily realized through the increase in stock price. When a company reinvests its profit, it's like a chef reinvesting in better ingredients. The results can be spectacular. So which strategy is the best fit for you? Stick around as we dive into the benefit and risks of each strategy and help you make the best choice of your investment goals. Because a balanced portfolio lets you enjoy the best of both worlds: the steady drip of dividends and the thrill of growth. So if you want to become an investor and learn how to build a smart portfolio that makes a lot of money while you are sleeping, be sure to watch my next video, because I will be discussing 3 special funds called ETFs that can help you maximize your returns even if you're just starting out. So don't miss out.